Harnessing the power of ETFs to access market returns and build wealth. In today's investment landscape, exchange-traded funds, or ETFs, have become a popular choice for individuals aiming to access market returns and build long-term wealth. ETFs provide a relatively low-cost, diversified, and easy-to-access way to participate in various market sectors, offering investors an efficient path to grow their wealth without the complexities of individual stock picking. This article explores how ETFs work, their benefits, and some strategies you can use to harness their potential for wealth building. What are ETFs? ETFs are a type of investment fund that hold a collection of assets such as stocks, bonds, or commodities and trade on an exchange like a stock. Because they often track a specific index or sector, ETFs provide exposure to a wide range of assets within a single investment. For example, the SPDR S&P 500 ETF tracks the performance of the S&P 500 index, which represents the 500 largest publicly traded companies in the U.S. ETFs can provide exposure to domestic and international equities, bonds, real estate, commodities, and even specific sectors like technology or healthcare. With so many options available, ETFs allow investors to create a diversified portfolio that aligns with their risk tolerance, investment goals, and time horizon. Why use ETFs to build wealth? ETFs offer several advantages that make them attractive for wealth building. Diversification. By investing in an ETF, you gain exposure to a broad array of assets within a single fund, reducing the risk associated with individual securities. For instance, a technology-focused ETF like the Invesco QQQ Trust provides exposure to leading tech stocks such as Apple, Microsoft, and Amazon without the need to buy each stock individually. Cost efficiency. Most ETFs have relatively low expense ratios compared to mutual funds, meaning less of your returns are eaten up by fees. For example, the Vanguard Total Stock Market ETF has an expense ratio of only 0.03%, making it an inexpensive way to gain exposure to the entire U.S. stock market. Liquidity. Because ETFs trade like stocks, you can buy and sell them throughout the trading day at market price. This intraday trading flexibility provides more control over the timing of your investment transactions, unlike mutual funds, which settle at the end of the day. Passive versus active management. Many ETFs are passively managed, meaning they aim to mirror an index rather than outperform it. This can be advantageous for long-term investors since the performance of actively managed funds can vary significantly. For example, a passive ETF like iShares Core S&P 500 ETF closely tracks the S&P 500 index, providing consistent returns that align with the broader market. Tax efficiency. ETFs tend to be more tax efficient than mutual funds due to the in-kind creation and redemption process, which allows ETF managers to minimize capital gains distributions. This efficiency can result in higher after-tax returns for long-term investors. Strategies for using ETFs to build wealth. Core portfolio building with broad market ETFs. One straightforward way to start building wealth with ETFs is by investing in broad market ETFs that track major indices such as the S&P 500, the total U.S. stock market, or the global market. For example, SPDR S&P 500 ETF provides exposure to the top 500 U.S. companies, giving investors a stake in the overall economy. Vanguard Total Stock Market ETF covers virtually the entire U.S. stock market, including small, mid, and large cap stocks. iShares MSCI ACWI ETF provides global exposure by tracking both developed and emerging markets. By holding a blend of these ETFs, you achieve broad diversification across various sectors, reducing risk while capturing market returns over time. Thematic and sector investing for high growth potential. Thematic and sector ETFs allow investors to focus on specific industries or themes that may have higher growth potential. For example, iShares US Technology ETF offers exposure to tech companies like Apple, Microsoft, and Alphabet, benefiting from the rapid growth in the technology sector. ARK Innovation ETF, managed by ARK Invest, focuses on high-growth, innovative sectors like genomics, artificial intelligence, and fintech. These sector-focused ETFs can complement a core portfolio by providing targeted exposure to industries with growth potential, though they may also come with higher volatility. Bond ETFs for income and risk management. Adding bond ETFs to your portfolio can reduce risk and provide a steady income stream. Bond ETFs such as iShares Core US Aggregate Bond ETF or Vanguard Total Bond Market ETF are popular options for investors seeking income. By including bond ETFs in your portfolio, you can create a more balanced investment approach, especially if you're nearing retirement and need to focus on capital preservation. Dividend ETFs for compounding and passive income. Dividend-focused ETFs offer another avenue for building wealth through compounding and passive income. Examples include Vanguard Dividend Appreciation ETF, which invests in companies with a history of growing dividends. Schwab US Dividend Equity ETF, which seeks companies with consistent dividend payments and strong financials. Reinvesting dividends can accelerate your wealth building by taking advantage of compounding returns. Additionally, dividend ETFs provide cash flow, which can be particularly beneficial during market downturns. International ETFs for global exposure. International ETFs, such as the iShares MSCI EAFE ETF for developed markets or the Vanguard FTSE Emerging Markets ETF, offer exposure to foreign economies and can diversify a U.S.-centric portfolio. Emerging market ETFs often include countries with rapid economic growth like China, Brazil, and India, potentially enhancing returns and helping investors take advantage of global growth trends. Getting started with ETFs. If you're new to investing, ETFs offer a user-friendly way to begin. You can start with a few core ETFs that provide broad market exposure and add thematic or sector ETFs as you gain confidence and wish to tailor your investments. Here are a few tips to keep in mind. Determine your risk tolerance. ETFs can be suitable for both conservative and aggressive investors depending on the types chosen. Generally, stock ETFs are riskier but offer higher returns, while bond ETFs are more stable and income-oriented. Set a long-term horizon. Wealth building with ETFs works best with a long-term perspective. Many ETFs mirror market indices, and while markets experience ups and downs, they tend to appreciate over time. Consider dollar-cost averaging. Rather than investing a lump sum, consider dollar-cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This strategy reduces the impact of market volatility on your portfolio and ensures disciplined investing. Rebalance periodically. As your ETFs grow and market conditions change, rebalance your portfolio annually or semi-annually to maintain your target asset allocation. This step can help you optimize returns and manage risk over time. ETFs are an accessible and flexible investment option that allows both novice and experienced investors to build wealth through diversified exposure to the markets. Whether you aim for steady income with bond ETFs, high growth through sector ETFs, or global diversification, ETFs can be tailored to meet a wide range of financial goals. By incorporating ETFs into a long-term investment strategy, you can capture market returns and work toward financial security, even amidst economic uncertainty. Credits, script by author name, voiceover by narrator name, produced by production company.